Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Richard Fitzgerald, co-founder and managing partner of CapitalSpring, a private equity firm investing in food service and multi-location companies in the US. We're going to dive in today two main topics. One, celebrating and understand how they've just managed to do the first close in a difficult fundraising environment. And two, a recent example of an exit to Bain Capital, 1 billion plus exit, the learnings, the journey. Let's dive in. Richard, if you could share with us a brief insight into you, please.
Thanks, Alex. I really appreciate you having me on the podcast today. I grew up in Nashville, Tennessee, and after college, I ended up moving to New York City for what I thought would be a 3-year stay working for an investment bank and an analyst program. After investment banking analyst program, I went on to join a generalist private equity fund for where I was for the better part of a decade. And at that firm, I was the only Southerner, so we did a lot of deals in small towns in the U.S. and oftentimes in the Southeast. So I would be sent down to every small town in Alabama and Georgia and Mississippi to meet management teams and try to convince them to not hire an investment bank, but just to sell their business to us. And over the course of many years doing that and finding that it was harder and harder to keep businesses from hiring investment banks and running competitive processes, I kind of stepped back and said, man, private equity has gotten crowded. It's gotten more efficient. And you look back when we started CapitalSpring in 2005, there were about 1,000 generalist private equity firms in the U.S. And now fast forward to today, I think there's 6,000 or 7,000. I've seen numbers higher than that, but it's continued to get more and more crowded. And I was feeling this back in the early 2000s. And always had entrepreneurial aspirations. Kind of stepped back and said, if we were to build a private equity firm from scratch, had a clean slate, how would we build something that had true differentiation, true competitive advantage? Because I felt that it was harder and harder to say you had that. Kind of mapped the industry, looked at who was successful when there were situations that were competitive. If somebody won a deal that weren't the highest bidder or the cheapest capital, why was that? And we kept coming back to these sector specialist firms. They were kind of an inch wide and a mile deep in a sector. And oftentimes there was I think there was even a Cambridge report that came out about sector specialization and returns. Like these were often groups that did generate higher returns than the averages, and oftentimes could attract management teams or deals when they weren't the highest bid or the cheapest capital. And this kind of started to interest us. And as we dug in, we said, well, you think about the big industries out there, technology or energy or healthcare. There's you can think of dozens of great firms that were specialists in each one of those that were all probably top quartile in many respects. And so we kind of thought that there was something there. We thought that was maybe a good approach to being differentiated and having a competitive advantage. But those industries were all pretty crowded already with sector specialists. There were long lines at each one of those. And so we kind of stepped back and said, where are the short lines? Where is there less capital chasing deals? What industries or segments or types of businesses just had less people lined up when something came up for sale or a company needed to raise capital? And we really had to look no further than the main streets of every town that we were traveling to look at these companies when I was as a generalist. No matter how big or small the town was, usually Main Street had a McDonald's and a Dunkin' Donuts and a Planet Fitness and a car wash and a Jiffy Lube and a laundromat. Like these were businesses that were often regional or national brands, but oftentimes had local ownership. They were part of a lot of people's daily routines. They weren't particularly high priced. So even in good and bad economies, these were kind of types of businesses that people still frequented no matter what was going on in the stock market. But in 2005, when we were kind of starting to really look around and research this potential opportunity, we could not find anyone that was exclusively focused on this. We couldn't find anyone that was kind of known for being what Sequoia is or Kleiner Perkins is in technology. We couldn't find that same kind of corollary in this area. But this area was huge. It was, millions of restaurants, for instance, across the country. Some of the largest, most iconic brands happen to be franchised businesses, when you think about it. And every main street had familiar signs, even if they were locally owned. And to have something as pervasive and large, that we couldn't find a single group that was really known as the expert or known as the smartest people in the room, we felt that was a real opportunity. And so in 2005, we launched CapitalSpring. We raised $3 million, not 3 billion, 3 million, to really test the market and kind of go and see if this was as interesting as we thought it was on paper. First deal was a tough deal. We learned a lot of lessons, but the good thing about it is when you think about being a sector specialist, you're doing the same deal over and over again. Those learnings that you have from each deal can be directly applied to the next deal. When I was a generalist, we would look at a lot of different industries. So any individual learning you had, you couldn't necessarily apply it to the next deal, and it was not as easy to kind of build real expertise when you were trying to be more diversified. And so launched CapitalSpring in 2005, and fast forward 20 years to today, obviously hitting our 2-decade anniversary. We've completed about 300 investments in about 100 different brands, kind of consumer-facing brands typically, and invested about $4 billion. And so obviously those numbers represent a lot of learnings and bruises and scars, but the good thing is that there's lots of best practices that come out of that we feel that we can continue to incorporate in our underwritings and our sourcing, and hopefully continue to generate strong returns for our investors.
Marvelous. Well, congratulations on the journey so far, and thank you very much for the insight. Another advert from my perspective on the professionalization of private equity. You've got to be different. You have to differentiate, narrow in your niche. Can't just be generalist and one thing to all people. Something we get asked as an executive search firm: what's your specialization? What's your USP? What makes you different? And I always ask them back, what makes you different? And typically all I hear is, we've got this amount of money. Money is the same for everybody. There's always somebody with more. We have done this exit. Well, I mean, I haven't come across a private equity firm that isn't top decile performance as of yet, which does bemuse me as to who is these average firms and how have I managed never to speak to them. Yeah, so interesting journey. So what's one mistake that you see private equity firms or portfolio companies making, and what would you suggest to correct them?
Look, I think that one of our learnings is the power of specialization, and that doesn't mean you're a sector specialist. You could be specialized on 2 or 3 different kind of areas, but it was just very hard to be a generalist. And I think that if you're open for business and hanging a shingle out, and you're getting books from every investment bank in a lot of different industries, it's just not as efficient to have to get up to speed on an industry every time you're looking at something. And almost by definition, there are other people out there that probably know more and can move faster and have relationships. So you don't really, I think it's just hard, other than price, to be competitive in that market, if you're a generalist, or in this private equity market if you're a generalist. And so I would say where people make mistakes is just being too broad, and not having kind of areas where you have you're starting on second base. You're not starting from scratch and writing a white paper, hiring a consultant, and typically trying to keep up with the process. And there's just too much pressure to try to get the first bid in, and you probably still don't have the understanding of the industry or the business that you really need to be putting that bid in. But I think when you can narrow down your focus to one or a few different areas where you're not starting from scratch for every deal to really understand the industry, or what good margins are, or have a network of referenceable or people that you can call to get references on the business or the people running it. It's just increasingly hard to be competitive in the private equity industry.
Yeah. So congratulations on a recent exit, Sizzling Platter to Bain Capital, 1 billion plus exit. Talk to us about the journey. Talk to us about the learning. Talk to us about the good, the bad, and if possible, the ugly.
Yeah. So this was an investment we made in 2019. We had gotten to know management over the years, given that this is the industry we play in. And they were owned by another sponsor that we had kind of started talking to, and felt that we could offer a fair price and maybe help them achieve an exit after a long hold. That was a successful exit for them. And so it kind of kept it out of a super competitive process. Got into the business, and what we liked about it was a scaled franchisee in multiple brands. And this is kind of, again, we look at 500-600 deals a year that look similar to this. This was a larger version of what we see every day, and we may pick 15 deals to do every year. But this was one that was in, I think, 5 brands at the time. It was a little over 400 locations in multiple markets. And we just saw that this scale of a franchisee had a lot of benefits. You had real infrastructure in place that was, got you to where you were, but you could leverage that, and you had multiple growth channels in terms of adding new brands. In the existing brands you have, you can grow through new development or consolidation. There's a big trend in these, so acquiring accretively to help grow the brand you're in by buying smaller operations and folding them into your platform. And so this was attractive. It was probably the 20th largest franchisee in 2019. I think it was is the number per kind of Restaurant Finance's top 200 list. And so fast forward over 6 years, we saw an opportunity to kind of run our playbook. Again, we do the same deal over and over in many respects with a different color neon on the front, or maybe a different type of food in a bag or service that the company's providing, but got in there and kind of had these growth channels that we do in many respects. You can add more brands, which we did here. We got into a couple of new brands over that period of time. We got into new markets. So we, through either acquisition, where we would acquire units and they had further units to develop in their market. So there was a kind of a pipeline of new opening opportunities. And then just continuing to grow through new development within the brands we were in. And we kind of reworked the platform to further professionalize it, institutionalize it. We took very much kind of a shared services approach, where each brand really had a brand leader, and they could plug into our platform for a lot of the back office and the IT and the marketing and things like that. But the brands within the platform, if it had 4 or 5 different brands, each of those brands kind of had direct relationships, or those kind of silos within the organization had direct relationships with the brands. And it was really kind of running a portfolio of brands, but everybody really doing the same thing. So we were able to scale that over 6 years from about 424 stores to well over 800 locations. We got into multiple new brands. We opened up 15 new markets. At the time of sale, which was in this last year, I think it was the 6th largest platform in the country. So had a great run. And what was hard with that is you look at those dates. We happened to hit the pandemic, which was quite possibly the maybe the black swan event for this industry or these types of businesses. So never a straight line. Fortunately, the brands that we were in were pretty resilient even in tough times. And while there was certainly a pause and a scary few weeks going through that pandemic, when we weren't sure if people were going to leave their house or order outsourced food anymore, in this instance, there was not too many months went by before people kind of realized that they didn't have to wipe their pizza boxes down with bleach to order pizza, or go through a drive-thru at a Dunkin' and get a cup of coffee without getting COVID. And a lot of these brands kind of came back quickly. A lot of them were already digitally kind of oriented in terms of a lot of the kind of go-to-market strategies were digitally enhanced. People were ordering online and getting it delivered. So it wasn't necessarily waiting for stores to open during the pandemic. People could get it delivered to their home or go through a drive-through at many of these. We were, it was a great kind of opportunity and a great deal for us, and hopefully the management team, and I think it'll be a great deal for Bain as well.
Absolutely. What's one thing you took from that deal that was a learning point or was significant, that has, whether it's micro, has changed future deals, future platforms, something you saw in it, something insightful from that particular investment?
Uh, I think just maybe the labor model, and look, I think we learned it because we went through a pandemic, and where labor was not only more expensive, but availability of labor was very challenged for a period there. There weren't enough people coming into work. A lot of people were sitting on their couches and not leaving, so hiring was very challenging. So not only were labor costs going up, but hiring was challenging. And I think we saw the benefits of having brands or business models that were less labor intensive. And so when you think about this platform happened to be in the restaurant industry. You see a Wingstop and a Little Caesars certainly need less people in there than a Chili's or an Applebee's. It's less labor intensive, and because most of it is oriented outside the four walls of the restaurant in terms of the sales, people getting it delivered or picking it up. That just, you're less reliant on labor and hiring and costs there than you may be in a very similar business, but just a different category of business. And so one of the things that I maybe didn't appreciate going in because we didn't have the labor challenges, perhaps to the extent we saw through the pandemic, that models that optimize for that are just more efficient on that front. Oftentimes we're a little less risky and could withstand times like these.
So private equity's been through a difficult time over the last 12, 24 months. My take on a lot of firms is either they can't raise capital or they're struggling to deploy capital. Now, you guys have just done a recent first close, Fund 7. What is it that Spring Capital's done differently that's not put you in the struggling to raise capital category and you've had a successful first close?
Sure. Well, I think one of the things that we were able to say today that we weren't able to say, 10 years ago, or maybe in past funds is we've got further kind of evidence that the types of businesses that we invest in are somewhat pretty resilient, even in through pretty serious stress tests. I think you look back and you think about underwriting deals and you do a sensitivity analysis and say, hypothetically, if sales were off 20%, how would margins compress and what does that look like? Well, we actually can sit here today and say, this is what happened when sales were off 80% or 50%. I mean, massive. And the businesses that we're investing in today are by definition survivors of, a black swan event in these types of industries. And so I think we've been able to go back to people and say, look, we've invested in businesses that on the surface probably have somewhat of a stigma if it's in the food service or restaurant space, or a lot of these businesses were ones that through the pandemic, people were worried if they'd still be around or if they would survive. But not only did a lot of you survive, they came out stronger and thrived. And we can look back now and say, look, our strategy has been battle tested. We've been through now a pandemic. We were around through the 08, 09 kind of recession and in capital or just global capital markets kind of disarray or headwinds. So I think that we talk about it now with real data on kind of the resilience of these types of businesses. And I think the other things that help us differentiate and I think is appreciated by our investors is we're not a traditional kind of private equity firm in the sense that we're just deploying equity kind of and using leverage to buy businesses. We have very much of a hybrid approach. And so we're more of a solutions oriented investor than a traditional private equity fund. And which means that we can provide both debt and equity in these deals. And while some may be just debt with warrants where we're a minority holder and some may be a control situation where we're the debt and the equity, we can really provide a solution to good operators. And I think that helps differentiate in terms of if you're not ready to sell your business, but you've got an amazing business and you just need capital, we can be relevant. And that may mean you sell your business in 3 years and we can be front and center because we've been in your capital structure, gotten to know you, and hopefully if we liked you then, we like you more now, and we could be a buyer of your business. And I think that really differentiates. And from an LP's perspective, it's somewhat uncertain time in terms of what private equity returns are going to look like, especially for vintages in 2020 and 2021 and 2022. Because we've got a mix of debt and equity in our portfolio, I think we kind of offer a alternative to traditional private equity where you've got some current pay because of the debt components. You've got some J curve mitigation, so you're getting some money along the way, not just waiting for 7 or 8 or 9 years. And when you look at kind of our mix of debt and equity, we're I think a little more defensive, given that we're at the top of the capital structure in a lot of these businesses, but can still get that equity upside and are very much oriented as a firm to driving the value of the business. It's not just you're capped at an interest rate. We're getting that along the way, but very much have a team that's got very operational focus. We've got in-house kind of operating teams that go in and very much try to drive the value of these businesses, and we can the shareholders or not the shareholders, probably the LPs in our funds can benefit from that. So I think that was something that in an uncertain environment where people are questioning whether real returns in private equity, what should the expectations be, to have a little bit of a hybrid approach not only helps us in sourcing deals because we can be relevant to a bigger kind of pool of opportunities, but in terms of the portfolio construction, it's kind of still targeting those private equity type returns within the band of where people's expectations are for private equity, but doing so in a way that has got a mix of debt and equity, so theoretically a little less risky and a little less volatile in terms of the way we're generating the returns for LPs.
What do you watch, read, listen to that you recommend that others should check out, please?
I think we were talking earlier. I listen to a lot of podcasts and read a lot from other people in private equity. I think there's so much to learn by how other people are running their businesses, how they incentivize people, how they attract people. I'm always trying to kind of hungry for hearing stories of ways that other people are doing it with success, and how can we improve our company. I think that a book that I've read fairly recently that someone sent to me was I think is interesting, just about building relationships, and it's called Give and Take by Adam Grant. I don't know if you've read that. But it's when you think about private equity firms, and I talk to a lot of younger people looking to get into the industry, and everybody, usually interviews for how well they can build a financial model, or how well they can build a PowerPoint, or run a process. But at the end of the day, those are all skills that are important, but they don't necessarily, lead you to being a senior or a partner in a firm. What really drives that is I think how well you can manage relationships and attract deals, attract capital, attract new team members, and that's something that I think is critically important, just in business in general. People want to do business with people they like and trust, and not the best financial modeler or the best PowerPoint kind of presentation kind of manufacturer. It's really learning how to cultivate relationships and maintain relationships, and figuring out ways to help people is a great way to kind of build those. And so, this book by Adam Grant kind of talks to that. It takes a little bit of a different approach, which I thought was kind of interesting, and I think it plays into the types of people we're looking to hire and the types of management teams we're looking to back.
Thank you for sharing. That's one, though. Not seen up with my Amazon basket post this. How does anybody get in touch, Richard, if they wish to do so, please?
So I'm on LinkedIn. Also, if you go on our website, there's a link to my email address. It's rfitzgerald@capitalspring.com. Pretty straightforward, but would welcome the opportunity to talk to anybody in the multi-unit or franchise space, or others interested in learning more about us.
Perfect. Well, thank you very much for coming on to the Private Equity Podcast.
Thanks, Alex. Appreciate it.
And thank you very much again to all our listeners. Till the next time, keep smashing it, and thank you for listening.